Your credit score is sitting in the 600s or the low 700s. Your payment history is clean. You never miss the payment, but your score is stuck and it refuses to move. The problem is not what you think it is. It's your utilization, and it's silently costing you points every single month. In this video, I'm going to show you 4 strategies to higher utilization and push your score past 750. One of them is something that I never seen others cover, and it works fast. But there's also a strategy on the list that some people use without understanding the real risk behind it. I'll break that down too so you don't make a costing mistake. But first, if you're newer to credit, here's a quick breakdown of what utilization actually is. Credit utilization is simply the percentage of your available credit that you're currently using. So you have a credit card with a $10,000 limit and a $3,000 balance on it. Your utilization on that card is 30%. Your overall utilization is the same calculation, but across all of your cards combined, and it makes up 30% of your total credit score, which makes it the second biggest factor behind your payment history. Now, with that out of the way, here's the biggest lie in the credit world. You probably heard this 100 times. Keep your utilization under 30%. That advice is not wrong, but if your goal is to score in the 750s, 780s, or 800s, 30% is the ceiling, not the target. The people with the highest FICO scores average around 1 to 6% utilization, not 0, not 30%, right in that low single-digit range. Here's why that range matters. Banks want to see that you use credit, but they don't want to see that you depend on it. If every car reports 0%, you look like you're inactive to lenders. If you're sitting at 30% or higher, then you look like a risk. But when you're in that 1 to 6% range, you're sending a signal that says that you're using credit responsibly and you're not leaning on it. That's where you squeeze the most points out of the second biggest scoring factor on your entire credit report. Now, before we get into the 4 strategies, there's one concept that you need to understand because everything else builds on it. Your utilization is not based on what you owe right now. It is based on what reports to the credit bureaus. And that number gets reported on your statement closing date and not your payment due date. Those are 2 separate different days, and confusing them is what get most people stuck. So if you have a $10,000 credit card and you pay down $500 before your statement closes, you report 5% utilization. Even if you carry a balance for the rest of the month, that puts you right in the sweet spot, and that is the foundation. So let's get into the strategies. The first strategy is the most powerful long-term move that you can make, and it's something that most people overlook entirely. Shifting your spending from personal credit cards to business credit cards. Now, here's why it works so well. Most business credit cards do not report utilization to your personal credit profile. That one detail changes everything. That same balance that would crush your personal score on a personal card is essentially invisible on the personal side when it lives on the business card. So if you are a business owner running expenses on a personal card right now, your personal utilization is getting hit every single month. But if those same expenses move to a personal card, your personal profile stays clean, your score stabilizes, and you start looking a lot better to any lender pulling your file. And it gets better than that. Business credit cards typically come with higher limits. They also place more weight on payment history than balance percentage. So even if you carry a balance on a business card, as long as you pay on time, it's not going to drag your personal score down the way a maxed out personal card would. Now, if you don't have business credit yet, starting is way easier than most people think. You don't need to register an LLC. You don't need to have years in business. I do have a full video on this, which I will link up above. But the point here is simple. Moving your spending to business credit is the cleanest and most sustainable way to protect your personal utilization for the long run. And here's something that most people don't think about. If you already have personal card balances that are hurting your utilization right now, you can actually do a balance transfer from your personal card to a business credit card. This moves the balance off your personal profile entirely. Most lenders charge a balance transfer fee anywhere between 3 to 5% of the amount that you transfer. That is a real cost, but if the transfer increases your score by 50 to 100 points, that unlocks a funding approval that you've been sitting on. So paying a few hundred to make it happen is worth it. So run the numbers on your own situation and decide. The fee is a one-time cost, but that score abuse will keep working for you. If you do not have a business credit card set up yet, or you need to drop your personal credit utilization right now without applying for anything new, the next strategy works with the cards that you already have in your wallet. Now, this strategy does require discipline, but once it clicks, it's one of the most powerful tools that you have available to you right now without applying for anything new. Here's the core concept. Your credit card balance is reported to the bureaus on your statement closing date, not when you pay it, not on the due date, the closing date. So let me walk you through a real life example. You got 2 cards. Card A closes on the 15th and card B closes on the 20th. Both cards have a $10,000 limit and both are sitting at a $5,000 balance. So here's what you do. So before the 15th, you aggressively pay the card down so it reports it between 0 to 6% when it closes. On the 15th, card A closes and reports that low balance to the bureaus. Now you got a little window between the 15th and the 20th. What you want to do next is to do a balance transfer from card B to card A, since card A freed up all of that utilization. Plus, that card is reporting almost a zero balance, or 1 to 6%, to the credit bureaus. So this way, for the next 30 days, it will show that card A and card B will have a very low utilization. As a result, both these cards will report a low balance on your credit profile at the same time, even though there are some debt that you're just shifting between the cards. Something to note is that when you are shifting these debts, this is a balance transfer. Again, this will cost you a small percentage, so you really have to do the numbers to see whether or not it is worth it for you, or if you are planning to apply for something very soon where you need a little utilization. This works because lenders do not see your daily balance. They just see a snapshot from your statement date. That snapshot is what gets pulled when you apply for a loan, a mortgage, or business funding. So controlling what is in that snapshot is controlling what the lenders actually see. So to use this strategy, you really need to know the exact same closing date for every card that you carry. So log into your accounts right now and find a date. This is usually listed in the billing or account details section, so just write it down because that information is worth more than most people realize. Now, for the first two strategies, they are great with managing utilization on an ongoing basis, but if you're carrying a large balance right now, you need a bigger solution. The next strategy is the one that has moved the needle for most people in that situation. This is the strategy that I recommend most often to people who are carrying heavy credit card balances and feel like there's no way out. Here's the concept, and it's simpler than it sounds. Credit cards are revolving accounts. Revolving accounts counts directly towards your utilization score, but installment loans, things like personal loans, count towards your utilization much differently. So here's what it means in practice. If you have $30,000 in credit card debt spread across several cards, your utilization is going to get crushed. Your score is paying for it every single month. But if you take out a personal loan for $30,000 and you use it to pay off those cards, your revolving utilization drops to near zero. That debt is still there, but it is sitting in a category that pulls less weight to your score. I have seen a boost of upwards of 100 points from this one move alone. And the benefits goes beyond your score. Personal loans typically carry a much lower interest rate than most credit cards. Some credit cards are charging between 20 to 30% right now. A personal loan can bring that down anywhere between 7 to 18% depending on your profile. So you're not just hiding your utilization, you're also saving thousands in interest and setting yourself up to pay off the debt in 2 to 3 years instead of 12 to 20. So when it comes to where to apply, look for platforms that check multiple lenders at once and start with a soft pull so that your score does not take a hit for just shopping around. Some solid options include Lightream, Best Egg, Upstart, Prosper, and SoFi. Each one has a different criteria. If you have a strong W-2 income, Liverstream and SoFi tends to offer the lowest rates. If your income is harder to document, Upstart, Prosper, and Best Egg are more flexible. When you apply, just select debt consolidation or credit card payoff as your purpose. Many lenders may send the money directly to the credit card companies on your behalf. That keeps things clean, and it also signals to the lender that you are serious about how the funds are being used. Now, this strategy works best for people with credit profiles that clean everywhere except for utilization. So no late payments, no collections, no charge-offs. The only thing that's bringing your score down is just a debt that's sitting in your cards. If that's your situation, then you're a very strong candidate. Lenders know that high utilization is often a temporary cash flow problem, not a sign of irresponsibility. But if you already have a recent personal loan on your profile, getting approved for another one is going to be a much harder sell. In that case, the bridge loan strategy that I covered at the end of this video may be a better fit for you. Now, I have to make something very clear here because these two terms get mixed up constantly. Debt consolidation is not the same as debt settlement. Debt settlement is when a company tells you to stop paying your cards, let everything go late for 90 to 20 days, and then negotiate to settle the debt for less than what you owe. That strategy will destroy your score, burn your banking relationships, and leave negative marks on your report for 7 years. It is an absolute last resort and should be treated like bankruptcy, so never confuse the two. Real debt consolidation is when you move your revolving debt into an installment loan and keep paying responsibly. That's what builds your score back up. Now, debt consolidation is the best option for most people in this situation, but there's still one more strategy designed specifically for people who need to get approved for business funding fast and they need their utilization cleaned up before the application goes in. This last strategy is not for everyone, but if you run a business, if you're generating consistent revenue and you have a large funding approval on the line in the next 30 to 60 days, a bridge loan might be exactly what you need. A bridge loan is a short-term loan designed to solve a temporary problem. So in this case, the problem is that your utilization is too high now to qualify for the funding that you want. The bridge loan covers the gap between where your credit is right now and where it needs to be for that approval. So here's how the process works. You use a bridge loan to pay off your cards, dragging your utilization up, your score improves, you qualify for business funding, then you use a portion of that business funding to pay off the bridge loan. Now, here's what you need to know going in. Bridge loans are expensive. Fees typically run between 25 to 30% of the loan amount. These are short-term loans, not long-term financing. You just use one because the funding that you unlock on the other side justifies the cost. But there are strict qualification requirements. Bridge lenders typically will not move forward if you have more than 3 inquiries on any bureau in the last 6 months. They will also pass on any profile with collections, charge-offs, bankruptcies, or any late payments in the last 12 months or more than 3 new credit cards or 4 new more accounts opened within the past 12 months. If your credit file is clean and utilization is the only thing standing between you and a large approval, a bridge loan can be a smart short-term fix. But if you have other credit issues beyond utilization, skip this one and go with the consolidation strategy first. This tool is only worth the cost when your profile is clean everywhere else. So there you have it. 4 strategies to hide your credit utilization and push your score past 750. Move your spending to business credit. Control what reports by timing your payments. Use a debt consolidation loan to shift revolving debt to installment debt. And for those chasing a fast business funding approval, a bridge loan can be used as a short-term tool. Here's the honest truth though. If your utilization is this high, there's a good chance that something else is on your credit profile that needs attention too. A late payment here, a no collection there, maybe some inquiries that holding you back from your approvals. If that's the case, fixing your utilization alone is not going to get you anywhere that you want to go. You're going to need some rehab, and that's exactly why I built Credit Rehab Pro. It's a step-by-step program that covers every part of your credit profile so you can position yourself for real money. We're talking about 100 plus in business funding, 0% interest cards, and a kind of approvals that actually move the needle on your financial situation.